Hi, my name is Bruce Bolger. I'm founder of the Enterprise Engagement Alliance, and I'm going to share my screen here so that I can introduce our speakers on the issue of stakeholder capitalism, which has been getting a lot of attention in the media. And unfortunately, without a clear definition, uh, it's getting quite confused. So the Enterprise Engagement Alliance, as one of the founders of this concept of stakeholder capitalism, or founding promoters of it, I should say, brought together the people who've really been involved in this concept long before it became a subject of the New York Times, or the Wall Street Journal, or Barron's, or Fortune, or the National Review, all of whom have covered this subject prominently in the last 5 months. So while most people still haven't heard about it, it's going to begin to trickle down. So for part one of this, we're focusing on the people who were really involved in defining it so we can get clear what the definition is. And we're starting really with one of the earliest founders, and that's R. Edward Friedman, otherwise known as Ed, and he's a co-host here today. And he's a professor at business administration at the Darden School at the University of Virginia. And he's also author of Strategic Management, a Stakeholder Approach, which was published in 1984. So it's hard to go too much earlier than he in this subject. Then we have Alex Edmonds, who's been at this also for at least a dozen years, having done research on the subject when he was at Wharton, and he's a professor of finance now at the London Business School, and author of Grow the Pie, which is a fundamental book about the economics of purpose and profit and how they can work together. And then finally, we have Martin Whitaker, who for the last 8 years has been the CEO of Just Capital, which is the largest, most influential organization focusing specifically on stakeholder capitalism. And again, he was involved with this field long before it became a political issue, as we're going to discuss in the next minute or two. So again, we always have to thank our sponsors. These are the organizations that provide engagement solutions to help companies achieve their goals through people. So before we turn this over to our panelists, I want to kind of go over the definitions that are floating out there, because there is no formal definition for stakeholder capitalism. Look it up on dictionary.com or Merriam-Webster or Oxford. To my knowledge, there's still not a formal definition. And the formal definitions have become politicized. And one of them is, and this is from the National Review, a recent article, companies have an obligation to serve the interests of all stakeholders beyond just employees, customers, and shareholders, to involve the broader community of diverse individuals who have no direct connection to the company's interests. And this is from Wayne Weingarten, author of a recent National Review article entitled The Empty Case for Stakeholder Capitalism and ESG Investors. And if I define it that way, I might even agree with him. The Enterprise Engagement Alliance 2 years ago came up with another definition with the help of Alex Edmonds and also the help of Martin Whitaker, that defined it more on the roots where Ed Friedman was coming from, which is a business process, not a political process. And it is very simple. It's creating returns, however you might define them, for investors by creating value only for customers, employees, supply chain and distribution partners, and the environment. So we're not talking about having outside influencers other than within the purpose of an organization. So I'm going to stop my share here now. And I'm going to start first with you, Ed. You know, when you first envisioned stakeholder management, what was the problem you were solving? What were you looking to accomplish?
Well, a couple of things, Bruce. We were trying to help companies figure out how to deal with a turbulent external environment. Not in the sort of bureaucratic, no change sense, but the environment in the 70s and 80s, there was a lot of change, a lot of non-traditional competition, a lot of other things. The second thing I was trying to do was just trying to understand what business was. And it seemed to me that every business created, and sometimes destroyed, but tried to create value for customers, suppliers, employees, communities, and shareholders, and that those things went together. And that was, if I ever had an insight, it built on the people who came before me. And it was that, and I still think that's what stakeholder capitalism is. It says, business is about creating value for customers, suppliers, employees, communities, and the people with the money. And those things are connected to each other.
So where do you think this whole concept, this definition that both the left and the right have embraced, ironically, that's the one thing the left and the right agree on, that, it's really, I think, conflated with woke capitalism. Where did that come from, do you think?
Well, it came from the general brokenness of our political process, I think. Look, I've managed to piss off people on the left and the right. People on the right think I'm a socialist. People on the left think I've sold out to business. I was just trying to give an account of what good business looked like to me. And I came at it not being trained in business. So when I looked at companies, that seemed to me to be pretty obvious what they were doing. And I couldn't understand why anybody thought that this stakeholder idea, we called it stakeholder management in those days, I couldn't understand why anybody thought this was radical or really even interesting, because it seems so obvious that this is what business people did. And it still seems obvious to me, and I still don't understand why people think it's radical. I understand juxtaposed against shareholder primacy, this is a better way to think about business and a better way to create value when you realize this is what you're doing.
Well, and this brings me to a question to Alex. You have publicly debated this issue and with, Lucy Ann Bebchuk of Harvard Law School. And so why is the definition so important in understanding this? Because in a sense, isn't the battle really based on what definition you're using?
Well, first, Bruce, thanks so much for having me on. It's great to be here and talk about this important concept. And I think it's really important to have a clear definition of what stakeholder capitalism actually means, because you can't really debate it and talk about the pros and the cons unless you're clear about what it represents. But I'd like to stress that a clear definition is not just important for us to be able to have academic debates, but also to talk about how to put it into practice. So if we want to move forward and practice stakeholder capitalism, then the definition that we have will have a huge implication, because if we were to adopt Wayne Weingarten's definition, then we'd have to find a way of taking into account all stakeholders, including those with very little relation to the company. And that's a much more difficult way of implementing stakeholder capitalism than more focused definitions. So it's useful for academic debates, but also for practical implementation.
And to your knowledge, I've been following your work for a decade or more. I never heard in any implication of your definition this involvement of these disinterested third parties. Do you have any idea where that might have come from?
Well, let me try and stand in the corner of people who believe that companies should highlight on these third parties. It's because business does have a huge impact on wider society. So we see this right now, and a decision that a company makes will affect perhaps some innocent bystanders. So let's say Deepwater Horizon and BP, that had a huge effect on not only people, but also wildlife and the coastline and so forth. Also, we have huge challenges that the world faces. And we think that businesses should address those challenges rather than focusing on profits. But I think the concern that I and some others have who might adopt a more nuanced and focused definition of stakeholder capitalism is that we do have government regulation. And government regulation is an effective way of addressing people who might be harmed from capitalism and many other aspects. So the question of stakeholder capitalism is, should a company go above and beyond what's required by the law? I absolutely think so, and this is why I'm a proponent of the movement, but I would say that that shouldn't be completely unlimited, because we do have the law to protect some of these other parties.
Well, one of our panelists has made the point that the broader the definition, the more difficult it's going to be to adopt it, that coming up with these extra stakeholders outside of the purpose of an organization really complicates the matter. Martin, when you first got involved in this 8 years ago, okay, it's an organization founded by a hedge fund manager, a well-known one, and you've also been involved, I believe, with the Goldman Sachs Just Fund. This whole concept of woke capitalism and these disinterested third parties, was that even in your thinking when Just Capital, was founded?
No, of course not. The founding principle was that if you care about solving the world's problems, especially our more entrenched systemic challenges like climate or inequality, that you had to harness the intrinsic power of the private sector, that philanthropy and government were not going to get the job done. As Alex said, the government can set the rules and create the floor, but the truth is progress is driven by human spirit. And, you can't legislate your way to the American dream. In fact, you want more people, as many people as possible, to believe in that and to be pulling for that. So how do you create incentives for companies to be, in our parlance, more just? And just let me explain very, very quickly. The hedge fund manager in question is Paul Tudor Jones, who founded Robin Hood Foundation in New York City, probably one of the world's biggest poverty fighting organizations. And so he had a lot of experience with philanthropy, as did several of the other founding board members. And, I think they really felt that unless and until large corporations in particular, which is where we focus, began to do more of the heavy lifting out of enlightened self-interest, that these problems were going to get worse, not better. So the idea of politics, it didn't really come into it. In fact, on the contrary, we take our definition of what stakeholders matter and what the issues are from the American people. And we do that through extensive, fully representative public opinion research for those on the left and the right. And what I will tell you, Bruce, which Ed knows, having spent some time with Just, is that the good news is that people across the aisle, across all demographic groups, there's a lot of agreement on what really matters when it comes to this idea of stakeholder performance. It's not a divisive issue at all to think of a company paying a fair pay for a fair day's work. It's not divisive at all to think about good jobs in places that need them. That's just common sense. And as Ed pointed out, every CEO I've talked to knows that creating value for your stakeholders is the best way to win. It's the best way to compete and the best way to succeed. So I think we've created this sort of or society somehow, which we tend to live in a society that loves division, seems to seek it out. Is sort of creating this division which you refer to and hanging that on a political hook.
And Edward, I know that your job as a professor of this field isn't to worry about the politics of it, but it would seem to me that the ferocity of the opposition that we're seeing to stakeholder capitalism based on a definition that none of us ever envisaged really is a risk. Because these are major media outlets, and one of our panelists has pointed out the U.S. Chamber of Commerce has come out against stakeholder capitalism. So how is it a movement that I think Milton Friedman would have applauded? Okay, it's just better business. Become such a lightning rod, and what can we do? That's the purpose of this webinar. Almost, it's an emergency call to action. What can we do to counter this absurd opposition from both the left and the right?
Well, Friedman should have approved of it. I don't know whether he would have or not. But look, I think what Alex and Martin are saying is right. I would only add to that. People care about what businesses do in their communities and how businesses can be community builders and how they can be good citizens. And that's as important to the value equation as customers, suppliers, employees, and shareholders. So I want to be sure that's there. But of course, it's not anything goes. It's not a business can be all things to all people. That's why Alex's work on purpose is so important. This works much better when we have some purpose, which most entrepreneurs have. The problem with the political pundits is they're in the grip of this old story the old story about business says, hey, it's just about the money. It's an old story that the left uses it to demonize business, and the right uses it to make business saints. And this idea of seeing businesses as either saints or sinners is distinctly non-human. Oscar Wilde had the best line on that. Every saint's got a past, every sinner's got a future. We got to get out of the grip of this old story that business is just about the money. One of the things I love about what Martin and Just are doing is they're showing us what businesses are actually doing with respect to a bunch of issues that you could call societal issues, but they're also business issues, like paying a fair wage, like trying to understand what a business could do about racial injustice, or what business could do about what businesses have said and could do about the war in Ukraine, or about global warming. And we need to uncover that, because we need business to be involved in the solutions to our problem, but only on things that are kind of connected to what their purpose turns out to be. And most businesses have a purpose that's, not just making as much money as we can.
Hey, Bruce, can I make a point on that?
Please.
Okay, I think one of the reasons why you're seeing such vociferous pushback is the stakes are so much higher now.
Yeah.
10 years ago, ESG, stakeholder capitalism, it's a bit of a box check, like nobody really cared that much. Now, there's a whole system that is transitioning from what it was to what it will be. And it's not being driven by any one thing. It's being driven by a secular shift in how society is and how companies compete and what workers want and what they want from their lived experience. And so you got this confluence of things happening, which means that a lot of people see this as a threat. And when you see things as a threat, a threat to your world order, the way you think things like lifting wages is bad for investors. That's where it kind of takes you. And if you listen to Brian Cornell on the Target CEO this morning on CNBC, it's one of our media partners, they lifted wages today, in part because inflation is biting into the pay increases they've already given. And it's great for business. And their share price hasn't tanked. Surprise, surprise. It's gone up. So I think people are fighting like an old battle through through this sort of mythology. And that's sort of what we're sort of up against right now, because the stakes are so much higher.
Well, and that makes total sense to me. Alex, from your standpoint, what is the biggest risk really to this movement? And because you've pointed out many times the bogus and biased research, even that ESG promoters use, right? There's still a lot of just, fig leaves being thrown out there. What is the biggest risk to the stakeholder capitalism movement?
I think the biggest risk is the politicization and the polarization that both Ed and Martin have highlighted. So at the moment, you have some advocates who are very ideological, and these could be advocates as ardent opponents or ardent supporters. So if you are a supporter of stakeholder capitalism, then anybody who raises any hint of a question is just seen as being stuck in the 1970s. And similarly, there are people on the other side who argue that any proponent is just woke and just not of understanding that businesses need to make profit. So I think it's really important to look at the research that many dimensions of stakeholder capitalism are good for shareholders. It is good business, as Martin says, to pay employees a fair wage. The research shows that makes them more motivated and more productive. But also, there is a limit, right? Companies can't just have scant attention to profits, right? And just focus on creating social value, not considering all of those other things. So I think just this polarization and extremism is a concern. And if you look at who speaks on these issues, it is your incentive to be as one-sided as possible, because then you get a lot of attention. For example, Tariq Fancy, when he wrote his argument that this is all a dangerous placebo, he didn't actually include any evidence in his 40-page essay. There were a couple of anecdotes, but he used those couple of anecdotes based on his one experience at one company, BlackRock, to make a huge sweeping accusation against the entire sustainable investment industry. And I don't think that was fully supported. And then similarly, there were arguments in the Wall Street Journal where they were also quite one-sided. But then if you looked at the response to that, there was John Hale of Morningstar who responded to the Wall Street Journal claiming this is total BS, and it was a pretty unprofessional response, when actually, when not all of the arguments were correct in the Wall Street Journal, but some of them were. And I think it's much better to try to start with the idea of saying, well, what are the valid concerns? How can we address the valid concerns? And let me push back on the invalid ones. Otherwise, you might have a situation like Brexit and Remain, where Remainers like me love to think all the Brexiters were wrong and that we wouldn't even listen to their arguments. And you might have the same within the US elections. I think one of the good places to start is, rather than immediately thinking that the other side is absolutely wrong, is there anything in their concerns that we might actually put some validity in?
Well said. So quickly, Alex, to conclude your session, part of the session, where are we? I'm sorry, you're a Brit, but in Yankee terms, what inning are we in stakeholder capitalism, do you think? 1 out of 9.
Yeah, well, I spent 10 years in the US, so that's not bad for having that. I was trying, I immediately thought, oh, if I compare it to the 7th inning stretch, are we at that stage? I don't think we're there yet. Well, actually, what is tricky is that, and I know I'm not really answering the innings question, is that we are far along in innings in the attention paid to it. But I think we're not far along in terms of the expertise. So a lot of people, now everybody says, oh, we are now a stakeholder capitalist. You have lots of companies and investors jumping on the bandwagon. And in that, we are past the 7th inning stretch and the attention that it's got. But actually, all of that attention might not have been matched by expertise. So there are a lot of sort of claims which are not based on evidence. A lot of people are now thinking of doing ESG by the numbers. Can we measure every single aspect? And obviously, data is really useful. And as a finance person, I love data. But there are certain qualitative dimensions of stakeholder capitalism, like corporate culture, like diversity and inclusion, which you can't always measure in the metrics. So I think we haven't yet matched the enthusiasm for it with the amount of expertise that we have, and that also can lead to some rather blunt conclusions.
And thank you. And we're about ready to move on to the next section. So if anybody has any questions of these of our guests here, now's your chance, because they're going to be signing off. Edward, where do you think we are in this game, inning wise?
Well, I think I would agree with Alex. I think we're actually pretty far along. There's no going back to it's only shareholders. I think we're past that, but I don't think we're nearly as far along in understanding that, again, stakeholders are interdependent, and it's understanding the interdependence and how you deal with them. How does creating value for, to Martin's earlier example, how does creating more value for employees also create value for shareholders and customers? If we can unpack the interdependencies that are there, we can really accelerate, I think, the doing of this, not just the talking about that. And we need more research in qualitative and quantitative terms on those interdependencies, rather than seeing them as always a trade-off. If you look for trade-offs, you find trade-offs. If you look for how those things can work together, you might not find them, but you might. And that'll be the secret. The secret will be the extent to which we can uncover how stakeholder interests go together and how they're connected to purpose.
Well, you just said it. When you have a clear purpose and the organization states the purpose and what its objectives are, then let the investors decide whether they are on board with that.
Well, I mean, I don't disagree with the Wall Street rule. If you don't like what we're doing, sell the stock. But, I think purpose, it's too easy to talk about purpose statements. Purpose lives in the processes.
Yep.
It lives in the systems.
Yep.
It lives in how we treat each other every day. And that's the thing that, again, from the standpoint of a business model, we need executives to understand that. And I think they're beginning to. I can certainly say 40 years ago, nobody cared. And before that, when the idea started in the 60s, nobody cared. So we're
when you
way
talk
far
about-
along if you take that perspective.
Well, moving over to Martin, just to say though, when you align when you understand their interests and you align their interests, that's when you get the best results. It's about getting people focused on the same goals. Martin, to conclude with you, how far along do you think we are? And do you agree really with Alex and Edward and Ed right now that the challenge is implementation? How do you break down those silos and create alignment?
I definitely agree.
Not easy.
I definitely agree. The challenge is implementation. For that, you need a whole infrastructure. You need a whole set of data that you can compare. If I said to you, Bruce, I'm going to start this company and I have a policy to be really profitable, would you invest? Of course you wouldn't. You'd want to see real numbers. You'd want to see an actual plan. You'd want to see progress towards that. So that's what we need with stakeholder value creation. That's why we've been pushing the Business Roundtable to go one step beyond what they've done with restating the purpose of the corporation and start to put some definition around that. What does value creation mean for different stakeholders? Then we can start to look at how to measure that. I think other efforts to try and make sense of the alphabet soup from the bottom up are coming at it from the wrong angle. I understand why that's important to try and have a consistent framework, but really this is about from the top. How do you begin to think about value creation for stakeholders? And then how do you measure that? And how do you disclose to the market what you're doing? I'm a little less sanguine about progress. If you think about this in like 30, 40-year cycles, maybe going back to the last 40-year cycle of shareholder primacy, and let's say we're 5 years in, I think we're in the second inning, maybe the third.
Well, thank you for that. And we have one question here, and this might be to our two academic partners here. How can academia and think tanks, and that refers to you actually, sorry, Martin, how does think tanks help translate more complex topics and messages into relatable, simplified messages? Part of the allure of divisive rhetoric is that it's simple and easy to rally around. We need the same approach for the opposite messaging, and I think you all have a role to play in that. Curious in your thoughts. I guess the real question is, do we really have to focus on this definition because that's where all the battle is occurring? And Martin, since you're on screen, what's your answer to that?
Translating complex topics and messages into sort of relatable, easy to understand narrative is not new. We do that in lots of other areas. So I think we've got to look at other sort of areas around health, for example, where we have not done a good job of that, like climate. I've been in the ESG space for, 25 plus years, and climate has been one of the worst communicated risks and issues that you can imagine, because most people don't either believe it or they don't. They think it's like an article of faith, not science. So I sort of feel as though this is not, there is going to need to be real input from a community of people, from academia and think tanks for sure. But in our case, we work with media partners, mentioned CNBC, we work with foundations, we work with companies to really try and simplify the message for the right audience, including getting the messenger right. So I don't know, that's kind of a broad answer, but I think it's a really great question, and one that you need to be really sort of deliberate about targeting.
Well, Alex and Edward, I'll ask you then, how are our universities, they jumped on the E of ESG about 10 years ago with craziness, but I haven't seen the same interest in the academic world on the S. Edward, Alex, to conclude, are we seeing any movement on our universities focusing on the S of ESG?
Well, there's a group of people who do what's called social issues in management that have been around since the 70s. The ESG people came along and decided that this was some kind of new toy, and it's really, as Martin said, it's been around a long time, and so I haven't seen. maybe there's some societal issues that people haven't done much work on. There certainly needs to be better, more rigorous work. I think Alex would agree with that. But there's a lot of stuff that's been done in the last 35 years or so.
Well, that was the whole point of this webinar. This is not something that just came around 2 years ago. Alex, you have the final word on this viewpoint of the academic world addressing more the S of ESG in a systematic way.
Thanks. And I think Martin and Ed have already done a great job of highlighting how think tanks and academics could do a better job. So let me actually turn the question on its head and say, I think part of the responsibility does fall to the consumers of the research, the public, in that there's a lot of biases that we might have when we interpret research and see a study. So one bias is confirmation bias. So whenever there's a study which says ESG pays off, then if you're a supporter, you will accept it uncritically, even if it's flimsy. And if you're an opponent, you'll immediately dismiss it, even if it's really well done. And the second bias that we have is something known as binary thinking. So we see the world in yes or no terms. So why was the Atkins diet so successful? It said all carbs are bad. Not you should have carbs in moderation, but if everything is bad, then it's really easy to implement a no-carb diet. And similarly, if you claim that ESG always pays off, or it never pays off and it's a complete distraction, then you're going to get much more attention. So I think what part of the responsibility is on the consumers of research. That might be companies, it might be students, it might be investors, it might be journalists, trying to make sure that they're not just falling for simple soundbites.
Well, thank you very much. That's the essence of it. Alex Edmonds, thank you so much. Professor of Finance, Grow the Pie, a terrific book. It's on my shelf. Edward Friedman of the University of Virginia, really the father of this field. Martin, the work you folks do to advance it is incalculably important. So thanks to the three of you. And now we're going to switch over, folks, to the people who are at the front lines of implementation. How is it that we actually make this happen in organizations? And so our next speakers are going to be Dr. Solange Shiras. She's founder and CEO of HC Moneyball. And I'm hoping she's on this screen here. I don't see her. She's there. Great. Thank you. And she's adjunct professor in human capital management master's programs at Columbia University, University of Southern California, and New York University. And at the end of this, I'll also quickly tell you what she does. Eric Darisaw is principal of Lazarus Advisors, an ESG advisory firm, and board member of Interfaith Council on Responsible Investing. He is an early advocate for the human capital and the merger of human capital and the ROI of DEI, and we'll hear more about that from him. And then finally, Dr. Heiko Morterer, he's board member of 4C Group, an advisory company in Germany, who was on the ISO 30414 Human Capital Reporting Committee. And he is also an implementer and auditor of those standards, and he is an advisor as well to the International Center for Enterprise Engagement at the IC.org, which does certification work in ISO standards. So Solange, I'd like to start with you first, if you don't mind. And I'm going to take you off here, the share. And so Solange, my first question to you is, human capital is companies have said for years that, people are their biggest asset, but in fact, I think you would agree, it's usually been people are mostly a warm and fuzzy and viewed as a sunk cost. Why is that, and why is it now changing?
Well, I think one of the biggest catalysts for the viewpoint that human capital is no longer simply an expense is the SEC, who came out about a year and a half ago and said, human capital is no longer exclusively an expense to an organization, but should be viewed as an investment in an intangible asset. Now, the SEC didn't just wake up one morning and say, oh, we've got this great idea. They got the idea by understanding the academic research that it preceded that for about 30 years. So we, in the academic community, really understand that human capital is a driver of economic value creation if properly managed and governed in an organization. And with that, point of view, the SEC basically put a big red circle around it and said, you know what, it's no longer just a sunk cost. It really has to be thought of as a driver or creator of economic value and an integral part of the business model, not just this necessary evil that we need to invest in. And it's not just the academic community that gave the input to the SEC to rethink this. It's this whole stakeholder capitalism movement that says we need to understand our workforce, we need to understand what they want as a stakeholder, and we're getting a much sharper pencil on understanding how to quantify the impact of human capital on corporate outcomes.
And that's what your company does. HC Moneyball, what data are companies? I think you've often said that companies or CEOs are driving with one eye on the road, in a sense, that they are missing a huge area of wealth creation. What basic data are companies not looking at that could be affecting their earnings?
So it's very interesting. I just had this conversation this morning with an investor who said, I've been in this business for 30 years. I've never heard of some of these human capital metrics that you're talking about, which our platform instantly calculates. But in the academic world, we've been studying things like HCROI, human capital return on investment, HCVA, human capital value add. We understand how to quantify the human capital performance of a company and correlate that to corporate financial performance. It is essentially a new concept, a new idea for the practitioner, for the financial professional or the investor. And what's giving access to stakeholders are these human capital metrics that have existed for 30 years. I've been using them as a consultant for at least 30 years, but it's sort of like the 30-year overnight, special sauce that companies can now look at to really bring onto the, evaluation platform, right? When you look at an investment, you basically never look at human capital performance. And now it is a very significant, sustainable indicator for investors to look at. And we don't have to look at the warm and fuzzy or the qualitative indicators. Because we've got these metrics, we can create the common denominator so that we can look at financial indicators and human capital indicators basically in the same dashboard and understand how they relate to one another. And if you're an investor or you're an analyst and you haven't integrated some of these human capital metrics into your matrix, evaluation matrix, you have to start including them.
And that leads me to, and we're going to get back to you, Solange, on this a little bit more. But I hope you're on the screen there. I don't see on mine, but hopefully you are there, because you've been involved in the ESG area for many, many years. But your perspective is very much focused on the ROI. In fact, I'm just looking here at my question here. You're a board member of a leading group that advocates for hundreds of investors. Why has this become a major issue, and what is your approach to when you talk about the merger of human capital and ROI of DEI? What do you mean by that?
Yeah, well, I'd like to start with kind of the history of our organization, because the idea that building on the panelists before us, that this just happened overnight is probably not an accurate description. I mean, the Interfaith Center really began its, for corporate responsibility, began its work 50 years ago on the question of South African and apartheid regime, and calling for full disclosure of starting with American corporate practices in how they did business in South Africa, and that's essentially a stakeholder capitalism approach that was further developed. And many of you, or many you may not be familiar with the Sullivan principles, which was essentially global standards for disclosure of how companies go about doing business, not only in South Africa but globally. That was actually put into practice, and really that spawned a lot of the work, what we now call ESG, which is requesting greater transparency and disclosure on how companies go about doing business and how they impact. Of course, we know the impact of that movement on the collapse of the apartheid regime in South Africa. That subsequently has evolved, and again, in terms of practice. And so the Interfaith Center is one of the largest ESG advocacy organizations in the world. So we take a different approach. We actually sit down with companies. We're not in, I think we rely on experts, but we actually sit down with companies and ask for full disclosures of those practices. And now we've evolved to actually monitoring their progress on those practices as shareholders. So when you look at even the new SEC rules that have been passed in the Trump administration, that didn't just happen magically. There were trillions of dollars in ESG investors asking for greater disclosure based upon some of the academic research that Dr. Charis is talking about. And now we're into the implementation phase of really getting an understanding through the disclosure process. And we also are looking at standards. When you look at the Sullivan principles, the global Sullivan principles, which was used as part of what is called constructive engagement. So we're talking, this is the enterprise engagement, constructive engagement. That was, we need to sit down with companies and evaluate their practices and their impact, and look for change. And that eventually evolved into greater discussions with companies about their employment practices in a whole process over the last 25 years of filing shareholder resolutions calling for the disclosure of EEO-1 data, which is human capital data.
So from your standpoint, in your new approach, isn't the emphasis really now, rather than the traditional activist approach, which is still important perhaps to particular causes, but that this is better business? That, in other words, DEI is when you properly implement DEI into your organization, you'll have a more diverse marketplace for employees, a more diverse marketplace for customers, a more diverse marketplace for supply chain and distribution partners. Do we see an opportunity in the investment community to turn this into, as you say, constructive dialogue, help companies see what they're not seeing, that, what Solange referred to, or I referred to before, as driving with one eye on the road? Can activists like you can help companies see with two eyes on the road?
Yeah, I have two responses to that. Any of you that follow the investment community are familiar with activist hedge funds. So what activist hedge funds do is that they take a position in the company and they negotiate with management on improvements that's going to improve the return on investment. And so when you talk about diversity, equity, and inclusion, first of all, you can't separate that from human capital. Diversity, equity, and inclusion is human capital. You can't separate your minority employees from the rest of it. It's all part of your human capital and employee profile of a company. But I believe that the activist community, if you look at a lot of the investors that are trying to engage on human capital, they are basically taking long-only positions in these companies. What has not happened, and which is going to be the evolution, is how do you measure it? how do you actually correlate the improvement in human capital practices and diversity, equity, and inclusion practices to the EBIT of the company. But one final thought I would say is that it is evolving financially. So you've seen the creation of the financial indexes, the Bloomberg Diversity Index. You have the Refinitiv Diversity Index. You have the Morningstar Diversity Index, which are actually financial indexes that rank companies based upon what has been in communities of color, the model, the NAACP fair share model, which has been around for several decades, which scores a company in terms of how they're engaging their communities, their employees, how they're working with their supply chain, and that is effectively stakeholder capitalism.
Well, thank you, Eric. Heiko, you're in the front lines of this whole concept of human capital reporting. You were involved with the ISO committee that developed the first standards, ISO 30414, for human capital reporting, and you've conducted now several audits. A lot of people think of ISO standards or standards and disclosures as a compliance issue. Can you explain how, in fact, the cutting edge companies view them as a business opportunity, and what does that look like?
Yeah, certainly. Hi from Germany to everyone. So first of all, thanks, Bruce, for inviting me to this great panel. I really appreciate this. And well, to your questions. So first of all, it's about the trigger why this human capital reporting standard was developed, and the second part is about the business benefits that you were referring to. So to the first part, the financial reporting and accounting standards were established decades ago and describe a company's financial performance in a standardized way, and how confident would investors, regulators, boards, employees be in the financial viability of any business, basically, if there was no conformance or standardization in financial reporting? How would the economic world work if each organization could, define on their own how they measure profitability and depreciation and things like that? So until 2018, there was basically no international reporting standard for an organization's human capital related performance. And the ISO 30414 aims to close this gap, and the standard represents the very first official international framework for standardization and conformance in the area of human capital reporting. So it's definitely leveraging the global credibility of the ISO organization for human capital disclosure standardization. So this was the trigger point for this specific ISO standard we're talking about here. And now to your questions around the benefits and why it is more than just being compliant if you implement the standards in your own human capital reporting as an organization, or even get certified by it. So the information I'm sharing with you now is not some academic information that I thought about and put it on a piece of paper, but this is based on several years of real life discussions with managers, HR managers, as well as CFOs, CEOs, COOs. And I asked them why they are thinking about implementing this ISO standard within their own human capital reporting, and why they are even thinking about getting certified. And there are already some companies who not only implemented the standard, but who already got certified, especially by myself and my organization. So, for example, some real life examples in the market are, for example, DWS, an asset manager based in Germany, but that is globally operating, and also Allianz, which is Europe's biggest insurance company, and Deutsche Bank as well. So they're all large, globally operating companies who not only decided to implement the standard, but also decided to get certified that they are compliant to this standard. And talking to those responsible managers about their reasons why and what kind of benefits they thought about led to a lot of interesting insights. And the first topic that everyone told me was one of the most important reasons why they did it was an ESG related benefit. Because by being compliant to this ISO 3414 standard, organizations can further position themselves in the context of sustainable corporate governance. It is directly contributing to the S and to the G in ESG, because it's not only about the workforce costs and about, I don't know, productivity. It's also about ethics and compliance and organizational health and well-being and things like that. So almost everyone I'm talking to in that context relates to this ESG context and is saying, well, we have a lot of ideas how we can contribute to the E in ESG as a company, as an organization, because it's the environmental thing. At least we can manage our CO2 footprint or something like that. But we are struggling how we should contribute to the S and to the G in ESG. And that's a very important reason why. And another very important benefit is also the capital market and investors' point of view. So ISO 3414, this human capital reporting standard, gives investors confidence that the assets that they are investing in have a strong and transparent human capital management framework, right? This standard addresses investors' needs basically for confidence and consistency and also validity in the human capital disclosure of organizations. And let me give a third example, and then I conclude my thoughts about the benefits. The organizations and the managers that I talked to about this topic really referred to, by implementing the standard, these organizations want to demonstrate they understand that human capital is a business opportunity and not just a compliance or cost issue, and a strategy for more sustainable profits and better returns for investors, for their shareholders in the future. So what I'm telling you is that this whole topic is not only, it's another standard and we want to be compliant with it and then let's go on with our real work, but these organizations, they look at this topic from a strategic point of view.
So that leads me to Solange, back to you. You have made a point. I go back a long time with total quality management. I was a young journalist covering that field, and companies were building into their business models high levels of defects. They were still profitable. They did well, but they just allowed 10% defects. And then, of course, the Japanese saw this and they began to focus on that. And ISO 9000 standards came about to help introduce a strategic and systematic approach, and the rest is history. The US has done a very good job over many years redressing that. Aren't we in a similar situation with human capital right now, where we are building in high levels of inefficiency into our companies, and because we're doing well and we look good on paper, and because people aren't measuring all the poor experiences that come out of poor management, unhappy people, Mondayitis, and bad customer service, aren't we building in and have accepted poor human capital management into our business models?
It's a really interesting question. I don't think that companies actually plan for poor human capital performance. I think that they're resigned to that, feeling that they are powerless in making changes because people are unpredictable. I used to tell my boss, it would be so great if we could just nail the feet of all our employees to the floor. We wouldn't have to worry about them leaving at night, not coming back in the morning. So I think that there's this sense of powerlessness or being out of control, especially now with COVID and the Great Resignation. Companies just sort of shrug their shoulders and throw their hands up and try to, the old spaghetti, let's throw something against the wall and see if it works. And we're seeing now in the last few weeks that companies are trying to throw money at the problem, right? pay more in salaries, give people bonuses, but it's not solving the problem, because you cannot either pay or cut your way, cut your expenses your way out of a problem. You have to understand the root cause. And what human capital analytics does is it helps you understand the root cause of the problem. It helps you quantify and optimize the investment in human capital programs to measure the outcome, not only on the human capital side, but on the corporate financial side. So the long and the short of it is, just like just-in-time management or the ISO 9000 standard, we need to bring a rigor and a discipline to understanding how human capital investments are driving sustainable performance, not short-term performance, sustainable performance for the organization, and using human capital analytics to inform decision-making about budget allocations, right? It's all about how we allocate our limited resources in the organization and trying to find the highest rate of return on that investment. And because human capital typically is the largest line item expense, it is the opportunity for the greatest leverage of positive impact to the organization if you do it well. And our message is to human capital practitioners and financial practitioners and general governance practitioners, including the C-suite and the board, you no longer have to guess. It's been a guessing game. Should we do more training and development? Should we do more mobility? Should we change the way we recruit? It's all guesses. And now with technology and with rigor, we no longer have to guess. We can use the same kind of approaches to understand return on investment in marketing and sales, return on investment in plant, property, and equipment. We have to bring the same discipline to understand the return on investment in human capital. And it can be done in a way that benefits everyone, all stakeholders in the organization, investors, employees, strategic partners, communities, and customers. So everyone wins.
Well, it's a great thing that you're an adjunct professor at 3 schools, because we have a lot of students to teach on this implementation. My final question to you, and this will be to the others as well, how important do you think human capital reporting is? You've said in some cases, I've heard you say that we've entered the show me era. How important is it, the work, say, that Heiko is doing in terms of human capital reporting and standardized reporting?
It's critical. It is critical. We're seeing calls for more transparency and more accountability. So it's not just, for example, whether or not a company has a DE&I policy. It's what progress is that company making on that policy. It is accountability, which goes all the way up to the board. It's a governance issue. And it's not just about the accountability, it's about the materiality of that as well, which is what the SEC is calling for. And all investors are calling for. They want to understand how every dollar invested in human capital is generating a return on that investment. So we can't just shrug our shoulders and say sunk cost. We have to rationalize and justify and create a business case for every dollar allocated to human capital.
And Eric, from the standpoint of ESG investors, how important do you think this type of human capital reporting is?
It's going to be very, very critical, particularly as companies try to grapple with the yes of ESG. There has to be, a kind of a evaluation of where you are today and where you're going in the future, and also a recognition that this is going to be a very, very competitive market. Even when you look at the issue of diversity, equity, and inclusion, it's not a compliance issue anymore. It's a question of market competition. And of course, this is very, very well understood, in the human resources management area. And I think that that competitive marketplace is going to push companies to get a better handle on what decisions that they're going to make in the future to attract talent And then, of course, I think with inside the framework, having companies get a better understanding on the type of culture that they're creating that's going to attract that talent and the types of investments they're going to make, in order to attract the talent and as well as retain the talent. All of that's going to be very, very critical to the whole reporting process. And I think that if companies do not make good decisions about their direction in the future, they're going to be at a disadvantage. Thomas Sowell, who's came out of Hoover Institution at Stanford, a well-noted Black conservative, said that he does believe in market forces, and that the companies that discriminate or engage in discriminatory practices, while he didn't necessarily believe in government intervention, he said that the marketplace will penalize those companies, and there will be a financial penalty that companies will experience. And I think as we move forward in a competitive marketplace, that's going to be very, very, very important to take a look at. And so there is an evolution. And I think that we're going down the path. And one final thought I would say, the shareholder activist community, I alluded to how they have engaged with companies in the past on a compliance basis. They're going to also have to shift their thinking in terms of what, from a fiduciary standpoint, and being able to evaluate what the return on investment and what diversity means to the balance sheet of that corporation.
Well, thank you for that. And Heiko, I'm going to give you the last comment as we get to wrapping up here. It seems to me when I hear all this, the biggest problem I have with implementation is that management isn't trained in this, plain and simple. And it's not that it's rocket science, but we're talking about CMOs working with CHROs, working with CFOs, having people breaking down silos. Don't we have a fundamental knowledge problem here? When you work with executives, that they really aren't trained in this?
Yes, absolutely. So first of all, this is not a topic that is only CHRO related, right? This is a topic that is business strategy related from my point of view. It's about the whole board, it's about the whole business, because if you're not able to attract and retain talent in the future, you will have severe problems in delivering to the market, right? This is a really topic about being able as an organization to deliver to the market what you promise to deliver. And this whole, one of the major aspects is a marketing aspect around ISO 30414. So by implementing the standard, organizations can really turn human capital reporting into a marketing instrument for talent, for customer and supply chain. And especially talent is increasingly asking for objective and transparent and comparable and valid information about potential future employers. So the topic is that I'm totally in agreement with you, Bruce, that there is not enough education about these aspects and about these insights. And I really loved Solange's explanation that she's trying to find and to get insights about the root causes of some problems and how to deliver measures that really address the root causes of some problems. And just one aspect about education. I'm holding lectures at German universities quite frequently about exactly this topic. And these are all students that study things like business administration with an HR focus and things like that. And when I tell them the story about human capital reporting, about human capital reporting standardization, about how this affects directly business performance, this is the first time they hear about this at the university. And they're master students, right? So this is a very good example that from my experience, you're completely right, Bruce, we have to push this topic more into the academic world and especially into the education.
And Solange is a one-person band doing this juggling with three. So folks, and she is. So just wrapping up, and I've left off, these are the terrific contributors to our meeting today. You should see a slide that shows the books of Edward Friedman, of Alex Edmonds, the work of H.C. Moneyball and Human Capital Management and Reporting, Just Capital's outreach group. And I'm so sorry, Heiko, I threw this together too quickly and I left out 4C Group, which is the world's leading auditing company for corporations for ISO standards. And we're very proud to work with Heiko on that. So in concluding, I'd like to thank our three speakers, Eric Darrisaw of Lazarus Advisors and ICCR, Solange Charras of HC Moneyball and adjunct professor, and Dr. Heiko Morterer of the 4C Group in Germany, ISO auditors. And just to let you know, we have all these free resources. We have books on implementation, enterprise engagement for CEOs, a little blue book for stakeholder capitalists, and enterprise engagement, the roadmap, and all of these free services and information to help companies. So I'd like to thank our speakers again and thank you for attending, and look forward to another program soon. Thanks again.
Thanks. Bye.
Bye-bye.